Hello and welcome to this video. In today's video, we are going to be taking a look at the dividend payout ratio, which is one of the most important parameters if you are into dividend investing. So a quick preview as to what we'll be capturing today. First of all, we're going to understand what is the dividend payout ratio. Here we'll also take a look at what is the retention ratio, which is very closely related to the dividend payout ratio. Next, we are going to take a look at what kind of a dividend payout ratio can we expect based on the maturity of the company. So there are certain companies which are just getting started and certain companies which have been there for a long time with very little prospect for growth. So how should the dividend payout ratio be for these companies and what that basically means? Then we are going to see if very high dividend payout ratios are actually good for companies. We are also going to see if low dividend payout ratios mean that something is wrong with the company or are they good for the company. We'll also avoid the biggest trap that dividend investors get into, that is just getting high dividends without taking a look at the dividend payout ratio. And this is a big trap. This can really make or break your account, so we'll get into those details. And we'll also understand how the payout ratio for us for the same company will and should change over time in case the company is having healthy operations. So how should that ratio change over time? We'll also take a look at that. And finally, we'll cover one more topic, which is, are negative dividend payout ratios actually possible? What do we actually mean by a negative ratio? How can this be negative? So we have lots to cover here. And after this, one of the main things that you need to look at for dividend investing, which is the dividend payout ratio. If you're not already looking at that, you are really missing on a ton of information and you're really taking very high risk trades. So without further ado, let's get started. And I hope at the end of this video, you will be taking much more informed decisions towards your dividend investing and you'll have much more confidence in your dividend investing and the returns that you can expect. So before we proceed further, a quick look at the disclaimer that whatever information I'm sharing with you is only for entertainment purposes. I am not a certified financial advisor and none of the information that I am giving to you is any kind of a trading or investment recommendation. So first of all, let's understand what is the dividend payout ratio. So companies have operations and those operations generate income. The companies also have expenses to make every single year. So when you subtract the expenses from this income, what you are left is with the net income, or in other words, we can say those are kind of the retained earnings. So from those earnings, a lot of different things can be done. So that's like cash which is left with the company after meeting all its expenses from its operations, right? So what can a company do with that cash? What can the company actually do with it? So multiple things can happen. The first thing is that the company can invest all of it back into its operations to basically update its operations, to basically expand its operations into new areas, new countries, new geographies, or it can simply buy back its own stock to give its stock price a boost and then return value to the shareholders. So a lot of things can be done with the money, that surplus money that is left with the company, right? And that is basically what is decided by the management of a company. So all these decisions are taken by the CFO, CEO, and the board of directors and the management of a company. So what is the dividend payout ratio? Dividend payout ratio is that percentage of this net income which is paid back in terms of dividends to its shareholders. So let's say a company is making $100 million in net income and they decide that out of this $30 million will be paid back as dividends to the shareholders, then the dividend payout ratio in this case would basically be zero point 0.3 or 30%. Why? Because for every dollar that the company has made in net income, and please note the word net income here, this is after subtracting all the expenses, this is the cash left with the company after taking care of all its obligations. Whatever money is left with the company, the percentage of money that the management of the company decides to share back with the investors in terms of dividends is the dividend payout ratio. Now, dividend payout ratio and there's another term called retention ratio are very closely related. Retention ratio reflects the amount that a company keeps with itself. Okay, so you can see that if the dividend payout ratio is 30%, then the company is keeping 70% of its money with itself. So the retention ratio would be 70%. If you want to go really in terms of the ratios, then if the dividend payout ratio is zero point 0.3, then 1 minus that zero point 0.7 will basically be the retention ratio. So that's the relation between the dividend payout ratio and the dividend retention ratio. Now, dividend payout ratio is something that you really don't have to calculate every time by looking at the balance sheet and seeing the profit and loss statement. So you don't have to really see what was the net income for a company for a particular year and then how much was paid out in dividends. You don't really need to do that. You can actually just Google the stuff, and mostly within the first two, three search results, you'll get information on what is the dividend payout ratio for a certain company for a certain year. So that's the easiest way to go about it. But this is exactly what the dividend payout ratio means: percentage of the net income that is being paid back to the shareholders in terms of dividends. Okay, and the actual money per share that will be given out will be basically the total amount being paid out divided by the number of shares outstanding. So the example that I gave, let's say a company made $100 million in net income and they have a payout ratio of 30%, so they're paying 30 million out in dividends. And let's say they have a million shares totally outstanding, so the 30 million would be divided by the million shares, 1 million, and so the per share dividend for that year would be $30. Now this is an extreme example, I just gave it for the sake of helping you understand the calculation, but the per share dividend is basically the total dividend being paid out divided by the number of outstanding shares. So with this definition out of the way, let's proceed. Let's take a look at some of the common payout ratios. And you can see here Microsoft, the first symbol MSFT is Microsoft. It has a payout ratio of 28%. Then we have Johnson and Johnson with 44%, Visa with 22%, Walmart with 40%, Coca-Cola with 75%, Exxon Mobil with 82%, Intel with 29%, Target with 29%, and McDonald's with 57%. So there's a reason why I selected these companies, because in the topics that we are going to see next, we will talk about low ratios and high ratios, and companies being in their mature state to companies which are in the technology sector, and we'll try to understand how the dividend ratios basically work, and why some companies should have low payout ratios while some others should have a high payout ratio, and what basically different values of these ratios mean. So just hang on till the end of the video, because we are going to understand whether 28% for Microsoft is good or not. Because note this thing, I'm saying 28% for Microsoft because 28% may be a very good number for Microsoft, but 28% may not be a very good number for another company which is in the same maturity stage at Microsoft but is in a different sector. So let's understand that. And the first thing we are coming to is company maturity. Now, what do I mean with company maturity? For companies that are just getting started, right, they have a lot of scope to expand. And when the company is in an expansion stage, it has tons of expenses to cover. So those companies will usually, and they should usually, have a low dividend payout ratio. Why? Because as investors, we want to maximize our returns. And one way of maximizing returns is through the growth of the stock. So let's say I invest $10,000 into a stock, and a year later that stock is worth $15,000, then I've made a 50% return simply based on the growth of the stock. Another way you make returns is through dividends, right? And that is based on the dividend yield. Now, if a company gave me no dividend at all, let's take an extreme example, no dividend at all, but gave me a 50% growth year on year in terms of the stock price appreciation, would that be a better investment? Or would another company which just gives me 5% growth on the stock price and maybe a 7 or 8% dividend yield, would that be better? For me, the company which is giving me a 50% growth is much better, because my $10,000 have become $15,000 in 1 year. But with the other company where I got a 7% dividend yield, I got only 5% of growth in the stock price. So my total return is 7 plus 5, 12%. So in one case, I had zero dividends, but I still managed to earn $5,000 on a $10,000 investment. On the other company, I got a 7% dividend, but I'm still making just $1,200 on the same $10,000 investment. So you have to understand, as investors, as traders, our job is to maximize returns irrespective of which channel they are coming from. We should not care whether we are getting returns via dividends. We should not care whether we are getting returns via options trading. We should not bother whether we are getting returns through the appreciation of the stock price itself. Our job is to maximize returns. So companies which are just getting started, companies which are in the nascent stage, they have a lot of capital expenditures, they have a lot of new markets to explore, and all this requires a ton of cash to basically expand. So these companies should ideally have a very low payout ratio, or at and in some cases they should not even pay out any dividends. And this is exactly what is happening, especially in the tech sector, because you have to understand, a technology company can rarely mature. Okay, why? Because technology changes very, very fast. So something which is changing very fast, do you think that industry can ever mature, that company can ever get mature? Look at Apple. Why does Apple have a very low dividend yield? They generate tons of cash, but they still want to retain a huge amount of that cash with themselves. Why? Because they are into the technology sector. Every year they need to pour in millions and billions of dollars into research and development to create new products which are at the top of the technology chain. They don't want to be lagging behind because of shortage of money. And because they are the top tier company in terms of their technology, they generate so much of cash flow, so they can provide huge amount of growth to their investors in terms of the stock price appreciation, rather than paying huge amount of dividends. Now consider another company, like the companies like Exxon Mobil, which are in the oil and natural gas sector. In those sectors, or consider a company which is into utilities, for example. So if you are a utility company servicing a state like California, where almost every acre of land that you can find out is already developed, it's already consuming as much electricity as it can, you know that all you have to do is simply maintain your equipment and maintain your operations. You really do not have a scope to expand, because you're operating in California. You cannot venture outside the state to other states, so there's very little room to expand. What will you do with the surplus money? You cannot basically do much with the surplus money. So for such companies, dividend payout ratios should be on the higher side. So when we look at dividend payout ratios, number one, if the company is just getting started, dividend payout ratio should be zero or very low. Why? Because these companies, the managements, should have confidence to retain most of the money with themselves and then reinvest in the company to give explosive growth. The dividends don't make sense for these companies. The kind of returns that these companies, which are just getting started, can get by expanding their business can be two, three, or multiple time returns. Dividends just cannot match those kind of returns. So if you're Coca-Cola, you're already selling your beverages in every part of the world that is there, obviously you don't have too much of a territory to capture unless you start coming up with new products which can also sell in those areas. But if you're a company, a tech company, which is just servicing clients in one state, in one country, then you have huge scope to expand. And then what we want to see with these companies is to retain a lot of money with them, and then to come up with plans to expand it to new geographies and basically multiply their sales, multiply the returns in terms of the growth of the stock. So first thing here, for tech companies, companies where the technology changes, companies which have to innovate consistently, the dividend payout ratios must be low. For companies that have to invest a ton of money into R&D, otherwise they're simply going to shut down at one point in time, the dividend payout ratios must be low. If you see a tech company paying 80%, stay away from that company, because that company will never have enough cash to invest into R&D, and over a period of time it is just a matter of time that they will lag behind all their competitors and they will not be able to basically stay in the competition. So those companies, tech companies, highly innovative companies, companies which need a lot of R&D, should have low payout ratios. Companies which are just getting started, which have a huge room to expand, which at one time, maybe 5, 10 years down the line, may become mature once they've captured most of the market, but today have a huge room to expand in terms of expanding into different states within the same country, in terms of expanding into different countries, different continents, different geographies. Those companies should also have a low dividend payout ratio. If you see high payout ratios in any of those companies, please be wary that there may be something wrong. The management is not really taking the right decisions, and in the long term, these companies will fail to grow. They will lack the competition. And so, if you're investing $10,000, forget about converting that to $15,000. If they stay behind in the competition, you can start losing your principal amount. We don't want to see that. We don't want to make dividends as a source of income at the cost of losing our principal amount. It doesn't make sense. that you get a 7 or 8% dividend yield in a year, but you lose 10% on the on basically the stock price falling down. So we don't want that. And the third thing is that companies which are mature, which have been there for a long time, which have captured most of the market globally, companies which have very little to invest in research and development because they're just into operations like petroleum companies, right? They just take out oil, they use the same kind of process for distillation and produce the different kinds of fuel. They've already captured the market. They are selling to everybody within the region in which they are operating. So they have kind of a consistent state of operations. They can afford to pay out a huge amount of the cash that they get in terms of dividends because they really don't have anywhere to spend that money, right? So those are the kind of payout ratios that you can expect for different companies. So we'll quickly go back and see Microsoft, very mature company. But as I said, one thing, mature companies should have a high payout ratio. Why does this company not have a high payout ratio? Because it's a tech company. Although it's very mature, it's been in existence for a very long time, but it is nevertheless a tech company, so it needs to have a lot of cash to continuously innovate. If you see, Microsoft needs to go into cloud computing, Microsoft needs to go into artificial intelligence, Microsoft needs to do a lot of stuff which is just coming up, and this is just needed to stay ahead of the competition. They went in with a search engine. They got into so many different areas. Why? Because if you do not innovate, if you do not put that money into research and development, then you cannot call yourself a tech company. Tech companies by nature have to be on the top of the technology tree. If you lag behind in a technology tree, then even startups will destroy you. So Microsoft, very mature, a company which has tons of cash, which can afford to pay a much higher amount of dividend, does a 28% payout ratio, and this is absolutely fine. Why? Because this company, being a tech company, needs to really innovate and invest a lot of money in R&D. Johnson and Johnson, they have tons of products, baby products, household products, very stable company. They sell in almost every part of the world. This company is really mature. Now, do they need to innovate? Yes, they have certain sectors. They work in control systems, they work in different things. So this company has some technology associated to it. They need to improve their products. So this payout ratio is very good for them. Why? Because they are a very mature company. They do have product lines which are very stable, which have been doing well for tens of years, and which will continue to do well for tens of years. But at the same time, they also have certain areas where they need to innovate and get into research and development. So they are still, for every dollar that they have in income, they're keeping 56 cents with themselves, which they can invest back into that research and development. So a very healthy payout ratio here as well. Same thing for Visa. Visa can afford to do a lot of stuff because they're keeping a lot of money back with themselves. And it doesn't just mean, when companies retain money, it doesn't mean they just have to put it into R&D. They can all, if they have surplus cash, they can always go back and they can buy back their own shares, which anyways brings the price of the shares up because of the buying pressure. And you're returning indirect value to your shareholders. You're not paying them dividends, but then you're just buying back your shares, which anyways is reducing the dilution of the shares. So the people who own the shares of that company own a more percentage of the company, just because now there are lesser number of shares available to be traded in the market. Coca-Cola 75%, Walmart 40%. Now Walmart, again Walmart is getting into online sales. It's trying to compete with Amazon. It had a lot of physical presence in terms of the retail stores. Now Walmart is trying to go big in terms of its online presence. So they definitely have a room to expand. They need investment. So 40% sounds fine there. Coca-Cola, as I mentioned before, they're selling Coke in every part of the world. 75% sounds fine for them. Why? Because the 25% is such a huge amount, and they have the same product selling. They don't have to invest in R&D. You don't see 15, 20 flavors of Coca-Cola coming out every single year. So and even if they have to come out, it doesn't require the kind of research and development that you would need to probably build a new fighter plane, right? That's a huge amount of research and development. For creating a new beverage, you don't need that kind of research and development money. Exxon Mobil, I gave you this example earlier. Huge, huge company paying a really high dividend payout ratio. Why? Because they have very stable operations. They have very mature operations. They are not into the innovative kind of a sector. Intel, again, very mature company, tons of cash flow, but they have a low payout ratio. Why? Because if you see the semiconductor or the processor battle, they're going from 14 nanometers to 10 nanometers to 7 nanometers. That's a battle. That's technology evolving. You want to keep reducing the size of the transistors on the chips. You want to keep on putting more and more chips, more and more transistors on the same chip. You want to keep reducing the thermal, improving the thermal efficiency of the transistors. So all that requires tons of research and development, tons and tons of research and development, which requires a lot of money. That's why Intel's payout ratio is low, and it should be low. If I would see Intel paying out 80%, I would stay away from that company, because I know they are into the tech sector. They have to produce the latest chips, and that requires a huge amount of money in terms of the R&D requirement. Target 29%, very good. Why? Because if you actually look at Target, they have been having a dividend growth year on year, and with 29%, what I know is that this company is not putting a too much burden on its financials to fund its dividend growth. So they keep increasing the dividend year on year, but with 29% being the payout ratio, they still have a lot of room to pull out additional money and maintain that dividend growth. So for those of you who are looking for stable dividend growth, Target is a perfect example. They've had a huge, a very long history of dividend growth, of increasing dividends year on year, and look at their dividend ratio right now. It is 29%. So very, very good dividend ratio. They are not putting burden on their financials. They can take a lot of hit during crisis like pandemics. If the sales go down, they can open new stores, any number of them, because they have a huge amount of cash left with them to basically fund their operations and take care of their emergencies. McDonald's, again, pretty much spread across wherever they want to be. Not a very huge room to grow. Not coming up with huge number of new products. Pretty mature company, paying out 57% in terms of dividends, and they basically are still retaining a sizable portion with themselves to meet any kind of emergencies. So here we looked at how the dividend ratios should be based on the sector of the company, based on the maturity of the company, and then we also looked at about 8 to 10 examples where I justified why these companies have a very healthy dividend payout ratio, although the payout ratio varies from the low 20s to the high to the low to 82%, right? And how is it justified? So let's go ahead and let's understand, are high dividend ratios really good? So again, the answer lies in the concept. High dividend ratios are usually not very good. So for me, if I see dividend ratios in excess of 60-65%, barring a few companies like Exxon Mobil or I mean some other companies, I would stay away from those companies. And the reason is very simple. If somebody has a dividend payout ratio more than 60%, that means they have to satisfy a lot of criteria for me to be okay with that kind of a dividend payout. The first thing is I don't want to see them in a lot of debt. The second thing is I want to see them in a kind of a business model where they're kind of recession proof. You have a financial crisis, you have a bubble blowing down, you have basically a mortgage crisis, or you have a pandemic. I don't want this company to suffer. So if this thing is a kind of a ratio with a company which doesn't have to invest in R&D, which doesn't need to innovate, and which is going to have stable operations, immaterial of the kind of the global macro situation that is there, then even a 70% payout is good. Why? Because these kind of companies will continue to generate cash, and tons of cash irrespective of what is going around in the world. Because if they are into like if you consider utilities, right, the last thing I think people would stop paying for is utilities. You still need electricity, you still need water supply, you still need a ton of things to run your household. High payout ratios are actually not good most of the times. Why? Because these companies are retaining very little money with them, so they have very little to invest into R&D. They have very little capacity to innovate. They have very little capacity to expand into new geographies or new territories or into new products. And they also have very little capacity to handle any kind of an emergency. Like if their sales go down and they have a lot of debt obligations, they cannot meet their debt obligations because they have to pay out most of their cash out in dividends. So these companies will very often get into trouble, or they will very often end up borrowing more money, which will put them into a even more leveraged position, or these companies will actually get into that kind of trouble which will result in an outright bankruptcy. So we want to stay away from companies which have very high dividend payout ratios, and for me that figure is around 60%. I want to be invested as a dividend investor only into companies where the payout ratio is less than 60%, which basically implies that the companies have enough money to fund their operations to fund any kind of emergencies, to fund any kind of growth opportunities, new product lines, or to meet any kind of emergencies like a financial crisis, a pandemic, or any other kind of a situation which can just happen to them. I mean, imagine a company which gets into some statutory compliance issue and it gets a fine from the government, and it is not able to pay that fine, so it has to either borrow money and basically take on a lot of debt, or it just has to cut on its dividends. Both things are not good for such companies. So I would suggest that you stay with companies which have a payout ratio of less than 50. You can go to 60, maybe even 65 for companies which satisfy the following criteria. Number one, they should not be companies which have to innovate or invest money into R&D. Second, they should not be companies which have a huge room to expand or a huge uh, growth potential. And one example of that is Coca-Cola. You've already captured most of the market. You're pretty stable in those markets. You are the leading brand, and you've been that, and you have a proprietary formula which gives you a kind of a moat around which you can build your sales. You don't have to worry about anything. And third, these companies should not have too much of debt, because mostly when you see companies filing for bankruptcy, the biggest problem is they cannot meet their short-term obligations. So it's not that if you liquidate their assets, those companies' assets would be less than their liabilities. That's not the reason for bankruptcy most of the times. The reason for bankruptcy is that they don't have too much of liquid assets. So whatever loans are payable within the next year, they just don't have money to pay off their loans. And in order to pay off their loans, if you start liquidating their assets, selling off their plants, selling off their assets from the books, they have enough money to basically pay off all the debt holders. But those companies are very risky to invest in from a shareholder point of view, because if you know, when a company gets bankrupt, the first people who get paid out are the people who basically have loaned money to the company. The equity holders, the shareholders, come in much later. So because of that reason and that reason alone, high dividend payout ratios are not good in general, because they reflect that the company is basically, the management of the company is themselves telling you that we have no room to expand, we have no room to grow. We basically are into a situation where a small amount of trouble will either force us to cut on the dividends that we are paying out, or it will have to basically uh, we'll have to put our company into a much more difficult situation by borrowing more money. So, in general, I would stay away from very high dividend paying companies, except to a certain extent, 60-65%. I would go to that figure provided the conditions that I mentioned are met. Then, second thing is, our low payout ratios good? In general, yes. Now, low payout ratios should not be confused with low dividend yields. As a dividend investor, what basically matters to you is how much money you're getting back for every $100 that you invest, and that is the dividend yield. So if a company has a dividend yield of 4.5%, that means for every $100 that I invest today in buying the shares of that company, within a year I'm going to make $4.5 on that in terms of dividends. So dividend yield is a very different concept. Payout ratio is a very different concept. What we need to see is and understand is the link between these two. If that 4.5% dividend yield is being met with a 80% dividend payout ratio, then I would stay away from this investment. Why? Because the yield is good, but the company is putting too much stress on its operations, on its finances. It's paying a huge amount of money that it is making every single year in terms of the dividend, and basically it has very little left with it to fund its growth, its operations, R&D, emergencies, whatever is needed. So are low payout ratios good? In general, yes. Facebook doesn't pay any dividend, but is an excellent investment for people who invested in early. They have multiplied their money multiple times. Google doesn't pay any dividends. Tesla doesn't pay any dividends. Are these companies necessarily bad? No, they are in a sector which requires daily innovation. These companies are coming up with new products on a daily basis. They are innovating on a daily basis. They are still on a growth trajectory where they can bring in tons of new features every week, every month onto their platforms. They can offer so much services, and they have to invest a huge amount of money into R&D. Tech companies are going crazy after artificial intelligence, machine learning, and all that stuff right now. The Internet of Things and all that stuff is taking a huge amount of research and development being put into these companies. So these companies need a ton of money. Do they have huge amount of growth potential? Yes. So why would I trade a dividend payout for a growth potential which I can get over the years, and where the growth potential can be multiple times of the dividend that I would capture? So are low payout ratios good? In general, yes. Low payout ratios are good. If you're looking to get the dividend income, even then if you're getting the same dividend income with a low payout ratio, what that means is the company is really, really healthy. If you, because you have to understand, if the company doesn't pay out dividends, it is going to invest that money into the company again. And if you get the returns in terms of the growth of the stock, that's as good as getting the dividends, right? You can, instead of selling the entire piece of stock, you can sell a few shares and capture the same amount of money that you would have otherwise captured by gaining the dividends. So our low payout ratio is good. In general, yes, I would stay with companies which have a payout ratio between 20 and 50% most of the times, provided they have a good dividend yield as well. And basically, you have to strike a balance. You have to see how much potential of the stock price growth is there, how much potential of dividend pay, how much is the dividend yield, and you have to compare these things. Now, we don't want to sacrifice the growth potential at the cost of a dividend yield, because the best of the best companies will not pay you more than 7 to 8% of dividend. And growth wise, the best of the best companies can actually grow by 100 200% within a single year, especially with tech companies, right? Tech companies don't pay dividends. So but you know what happens with tech companies: you get in at the right time and you can multiply your money by 5 10 times within a span of 5 years, 7 years, 10 years. So though that growth is explosive for these companies, and so the rate of growth will outdo the rate of dividend payout at any day. So you have to basically see what kind of an investment are you making. If you're trying to invest in very stable companies and get a stable dividend yield and probably get a 10 20% growth on the stock price itself, that's also fine. But then you have to strike a balance between the dividend yield and the growth possibility, growth prospects of a company. In general, are low payout ratios good? The answer is yes. Now, what do I mean by avoid dividend investing traps using the payout ratio analysis? This is what we have already covered. That if a company, let's see, I see a tech company, right? And that tech company is paying a dividend yield of 12%. And you are very, very happy with that, because 12% means for every $100 that you invest, you're going to be making $12 every single year on that investment. Plus, it's a tech company, so it should give you explosive growth as well, right? Well, wrong. If you don't look at the payout ratio, then you're going to get a wrong idea. And this is where uh, I'm talking about these kind of investing traps, because a high dividend yield, a very high dividend yield, if it is put out there, is usually a kind of a bait for the investors to invest, because a lot of investors simply invest for the dividends, and they forget to do the payout ratio analysis. That okay, this company is giving a 12% dividend payout, but where is that money coming from? Is this company putting too much pressure on its financials? If yes, then you have to understand the management is simply playing a gimmick. They are simply trying to pump up the sellability of the shares of that company by showing that they have a high dividend, but they don't really have the resources to pay off the dividend. If you pay a 12% dividend with a 30% payout ratio, then you're not putting any burden on your financials. So this company definitely we should invest into. But if you're paying a 12% dividend, which is way higher than what the market pays on an average, but you're using 90% of your earnings and you're paying out as dividend, and you call yourself to be a tech company, I would stay away from this company, because then I'm not looking at a company which is paying a 12% dividend. I'm trying to look at a company which can lose 100% of its valuation. That means whatever money I put into this company, I can start losing my principal amount. The last thing that I want as a dividend investor, as a short term trader, as a long term investor, or any kind of investor in the world is to lose my principal. Whether you make money on that principal or not is a totally different issue. We don't want to be losing a principal in the first place. We want a principal to be safe. And for a principal to be safe, if we are talking about tech companies, they have to stay at the top of the technology chain. They have to invest a lot of money into R&D. They have to have a lot of money for expansion. They have to have a lot of money to look into new products. Imagine Apple not having enough cash to update their iPhone for the next 3 years. Do you think Samsung and other mobile manufacturers are going to eat up their share? This is the number one company that we're talking about. This is a brand that people love. But if they don't innovate, if they just stop innovating, if they don't, I mean, right now they've come up with the M1 chip. Do you think if they continued using Intel's processor and just claiming that 5 10% delta enhancement in the performance of their laptops every single year, how many years do you think would they continue with that kind of a model and increase their sales? The M1 chip came in. It's basically shown that laptops can last a full day without having to recharge them, and now really have a laptop as a mobile device. I mean, my laptops, if I'm getting into video editing like 3 4 years back, I had to be constantly on a charging outlet, because I couldn't use that laptop for more than 2 3 hours. Now this is a generation of laptops where we are talking about 8 to 10 hours of battery backup at full performance. So this technology is basically changing the way the market works. And do you think this kind of a technology development would have been possible if Apple would have paid everything out that it earned in terms of its income to its shareholders? No, but because they have invested this money back, people are going to see low dividend payouts, but they will see an explosive growth in the valuation of the company. And so, for me, whether money, as I mentioned earlier, whether money comes in through any channel, the stock growth, selling option premium, or through dividends, it doesn't matter. If I want to sum all these three, four channels that are possible, I want to maximize that return. I don't want to maximize one particular channel. I want to maximize the overall return that I'm getting through all these channels taken together. So, if you look at companies and you look at very high dividend ratios, payout ratios, you need to ask yourself, what kind of a sector is the company working in? What is the maturity level of the company? Does it need to invest into R&D? Does it need to expand into new territories? Does it need to expand into new product lines? If the answer to any of these questions is yes, I want you to stay away from those companies. Why? Such a high dividend payout ratio, they cannot fund any of these activities. And eventually, if you put money into these companies, you will keep getting dividends, you may keep getting dividends, but the principal amount that you're putting in is at risk. Can payout ratio change over time? Well, yes. Look at Coca-Cola. Do you think they were always having a 75% payout ratio? No. When this company was getting started, they were building their supply chain. They were expanding into new territories. They were expanding into new companies. They were expanding into different brands. They were trying a lot of things out there, right? So at that time, they needed money. They needed to fund their operations. They needed money for growth. They needed money to basically pay off the debt obligations, because initially every company borrows a lot of money. So does the payout ratio change over time? Yes. So as I've mentioned earlier, when companies are less mature, they're just getting started, they have a huge room to expand, they have to invest a lot of money into their R&D products, the payout ratios will be low because the company needs a lot of that money to expand its operations, to fund its growth. Once the company reaches kind of a situation where it's kind of become a blue chip company like IBM became at one point in time. IBM was the company selling mainframes to everybody, right? So no major room to expand. You've already sold computers and mainframes to every possible company out there. When you reach that kind of a stage, the payout ratio will eventually increase, because then the management can decide, we either keep the money with ourselves from doing nothing if we don't have any other thing to invest in, or we just pay it back to the shareholders in terms of dividends. So yes, payout ratio can change over time, and how it should change is based on the discussion we've already had, based on the maturity of the companies, based on the sector, whether it's an innovation sector, tech sector, a sector that requires a lot of R&D, or into a much more stable sector that once you're established, once you've captured a market like utilities, you really don't need to do anything else but just maintain your operations. And what are negative dividend payouts and how are they possible? Well, negative dividend payouts, don't get confused with that. Sometimes if you look at the dividend payout ratios, they will be negative. And all negative ratios mean is that for that particular year, the company made a net loss. Whenever a company makes a net loss, so I said, right, when companies have a net income, percentage of the income that they pay out is the as dividends is called the dividend payout ratio, right? What if the income is negative and they still pay out a dividend? So some companies know that, let's say the pandemic was there, a financial crisis was there, so they know that they will be making a loss for a couple of months or a couple of years, maybe 1 or 2 years they will be making a loss, but their projections show that they need not cut on dividends, they can continue paying off their dividends, and eventually their operations will catch up, the company will be out of the recession or out of whatever crisis they're running into, and this is just a temporary kind of an arrangement. So in those years, since the net income is negative, the dividend payout ratio will also be negative, because now you're calculating the dividend being paid out as a percentage of a negative number, so the dividend payout ratios can be negative. So don't get confused with negative dividend payout ratios. It basically means that the company that year has made a loss and still it has continued to pay out the dividends. So this is what I wanted to cover, and we have covered a lot of information here, a lot of topics here. I hope this video was helpful, and I hope that this goes a long way in enabling and improving your dividend investing. Payout ratio is one of the most important things which people miss to look, because dividend yield is what captures everybody's attention, but payout ratio is what funds the dividend yield. So you just don't have to look at the dividend yield. You need to see what is sourcing that dividend yield. How is a company able to pay a particular dividend yield? And that is the real analysis that as investors and traders we need to do in order to make informed investment decisions. So hopefully this video was helpful. So please leave down in the comments. I want to know whether you were aware of the payout ratio or not, and if you've been investing into dividend stocks, have you been looking at the payout ratio or not? If no, please let me know in the comments, because that will really give me an idea that this video was helpful to you and it basically helped improving your further investment decisions. So I'll catch up with you guys in the next video. Thank you for your time, and bye bye.